Good evening, everyone. Thank you for your attendance over here. As usual, we will run you through our monthly market outlook. Next slide, please, Avinash. If we look at global economy, everywhere inflation is shooting up and growth is slowing down. We had predicted in Jan 22 that there will be demand destruction in commodities like crude, metal, and food, as they were consuming 55% of incremental GDP compared to their rate earlier of 8.1%. Clearly, they were consuming more than needed, and hence there was a need for prices to come down. Next slide, please. If we look at commodity prices worldwide, it has started correcting. Aluminium, zinc, copper, palladium all have come down. The price which we wanted most to come down, unfortunately, oil hasn't declined. That is more due to Russia-Ukraine situation than demand and supply. Overall, inflationary expectations have now started coming down. Hopefully, this will give some breathing space to central bankers. Global bond yields are now above pre-pandemic level across countries like US, UK, Japan, Germany, and France. Even the expectations of Fed rate hike have started marginally coming down compared to what it was in 3rd May 2022 versus 25th of May. There is a significant decline. The US job market continues to remain strong, and that's where we believe Fed may continue to raise interest rates. Next slide, please. In fact, the Fed's behavior is probably unknown to Fed itself. On one side, they many a times talk about US economy doing soft lending. On other side, many a time they talk about no guarantee of soft lending. Clearly, in this uncertain world, with Russia-Ukraine situation and commodities inflation putting pressure on central banks, no one is sure about how things will move in future. In a lighter vein, if one looks at Fed rates linkages to the height of the Fed chairperson, they had the interest rates in double digit when they had Paul Walker at 6'7". Then it came into high single digit with Ellen Greenspan at 5'11". Then it came into mid single digit with Ben Bernanke at 5'8". And then it came into low single digit to 0 when Janet Yellen was 5 foot. When they chose Jeremy Powell at 6 foot, no doubt they were talking about US Fed rate going higher. This is an interesting slide. Many a times people get worried when debt funds fall by 1%, 2%, 3%. But look at the PIMCO's 25-year zero coupon US Treasury ETF total return, it's down about 40% from the top. In a zero coupon bond with 25-year duration, certainly when interest rate goes up, you can lose a lot of money. This year, S&P 500 has corrected sharply. Compared to the previous correction, this correction is fairly sharp, and hopefully it will not last as long as other bear markets. Already S&P 500 valuation is all below 10-year historical average. That means equity markets are now trading at reasonable valuations compared to the past. Small and mid caps are now below 2018 bear market valuation. If we come to Indian economy, then we are looking at a fair number of positive data. GDP grew 8.7%. It is highest in 22 years because of low base of last year. But India is one of the fastest growing major economy in the world for FY22. Exports continued to maintain robust pace, but trade deficit widened to $20 billion. Labor market added maximum number of jobs post-COVID in the month of April. In India's Kundli, Rahu and Ketu is both linked to oil prices. Unfortunately, as other commodity prices corrected, oil prices continued to stay elevated. This is despite the fact that OPEC increased oil production by 600,000 barrels, and yet oil prices have remained higher. This year, FY22, we became fastest growing major economy, and it is likely that we will remain fastest growing major economy in CY22 stroke FY23, that is the current year. GST collection declined in the month of May over April's record collection, but still remain well above 1,40,000 crore. Economic activities have now reached all-time high level, and it is maintaining despite some increase in COVID cases. Credit growth after some amount of time has gone back into double digit. Partly this is because of inflation as working capital expanded, but partly this is also because of demand from businesses for investment. Foreign direct investment continued to remain strong, even though FPIs were selling aggressively. And compared to 2013, FDI has increased almost 100%. Now, on a regular basis, we have been getting FDI of upwards of $50 billion. The capacity utilization, which had declined in COVID period, is now starting to improve, and we are looking at about 70% plus capacity utilization in this year. As capacity utilization started improving across some industry like commodities, capital expenditure plan or investment plan started fructifying, and we have seen some pickup in new capital spending. Real estate sector had declined from about 12% of GDP to about 8% of GDP last year. This occurred for a variety of reasons, but now stars are aligned for real estate sector to move further. One, house prices have remained constant throughout the country. Income level has gone up for some people. Hence, affordability has improved significantly in real estate. Inventories have started coming down across India as demand emerged and new construction didn't materialize with speed. Overall, with housing interest rate loans still at 6.5%, 6.75%, we believe real estate sector will do well and in turn lift the economy. This year, monsoon is expected to be normal, and thanks to La Nina effect, monsoon is likely to go from about 97% of long-term average to 103% of long-term average. Inflation undoubtedly has remained higher. It is crossing RBI's upper target range of 6%. But if oil prices continue to hover around $100, then September onwards, inflation should start coming down. Overall, this year, FY23, inflation is likely to remain above RBI's target range of 6%. GDP growth for FY23 is likely to be between 6.8 to 7.7%. A lot of this will depend upon how oil prices move. If oil prices go into double digit, we could be looking at 7.7% GDP growth. If oil prices heads higher from current level, growth undoubtedly will get impacted and we will be looking at sub 7% growth. In this global uncertainty, as I mentioned earlier, India will remain fastest growing major economy during the period 21 to 24. Overall, if we look at other emerging markets, India continues to score higher, and which is where we get the confidence and comfort that at some point of time, FPIs will start reducing their selling in India and eventually may turn out to be buyer over next couple of quarters. Looking at equity market, if we look at on a one-year basis, the returns have come down to high single digit. Small and mid cap outperform large cap by a marginal number. Over 3-year period, however, small and mid cap continues to outperform large cap. But again, on a 5-year basis, they continue to underperform large cap. From a sectoral point of view, the biggest hit on a 1-month basis came in metal. That's primarily because they had risen significantly. The other sector which corrected was energy. Again, on a 1-year basis, that was the best performing sector. This last month, bearing auto and FMCG, most other sectors have delivered negative return. On a 1-year basis, the best performing sectors came from energy, real estate, media, FMCG, auto, and IT sector. If we look at the battle between domestic investors and foreign portfolio investors, well, the battle still continues. Between October 21 to May 22, FPIs have sold close to 2,05,000 crore worth of stock. Against that, domestic investors have been big buyers of 1,68,000 crore, and which is where markets have corrected just about 14%. In Jan to March 20, FPI sold about 48,000 crore worth of stock, and markets corrected 38%. Compared to that, this time, despite FPI selling aggressively, domestic investors have kept on buying, and hopefully, like October, November 20, when FPIs who had sold in March 20 came back to buy, we will see repeat of the same. If you look at FPI's ownership from a high of 21.5%, today they are at 19.5%. If we take into account selling in the month of April and May, it is quite likely that number would have come to somewhere around 19% today. The lowest FPI holding was about 18.6 times. So today we are probably at 19%, taking into account April and May selling, and the lowest was about 18.6%. Hopefully, we are in the end of FPI selling from ownership point of view. As FPI ownership has decreased, undoubtedly, domestic institutional investors' ownership has started increasing. While I did mention that from ownership point of view, FPI selling should be towards the last leg, from a valuation point of view, that is not likely to be true. India continues to trade at a significant premium to its other peers. Historically, we have traded at about 40% premium to our peers. Right now, we are at 60% premium to our peers. Will FPIs continue to value India at such a high premium valuation, or will they continue to book profit? That's a $1 million question. The other way to look at FPI selling is the fact that they have made so much money in India compared to other markets. All emerging markets index, MSCI emerging market index, has delivered about 4% return in last 8 years in dollar terms. We have delivered double that of return. We have delivered double the return of China. We have delivered 9 times return of Brazil. We have delivered 9 times return of South Africa. Undoubtedly, when FPIs are trying to book profit, India is the only emerging market where they can book profit and get an exit. Despite this aggressive FPI selling, India has continued to outperform other peers. Brazil has been big outperformer thanks to being a commodity country. But after that, India has done well compared to markets like Japan, France, Germany, Korea, and emerging market, which has declined 1.5 times India. At this point of time, while valuations have indeed corrected, we believe it's still a neutral weight call, and momentum wise, it is still neutral allocation call. From a market cap to GDP ratio against our historical average of about 81%, we are currently trading at 98%. However, global market cap to GDP ratio is roughly 125%. Compared to 81, compared to 81, 98 looks high, but compared to 125, 98 looks low. If we look at valuation from a PE point of view against historical average of 18.4, we are now just about at historical average at around 18.7. Against price to book of 2.7, we are just around at historical average of 2.9. So valuations indeed have corrected in recent times. If we look at March 22 quarterly results, by and large, they have been meeting expectations. They are little below expectations. Against expectation of 23% profit growth came at 21%. However, composition of this profit growth has changed in favor of commodity companies rather than structural stories like IT pharma. Of the 50 companies which have declared results in Nifty so far, 27 companies have seen earnings downgrade in FY23, FY24 estimates, whereas 23 companies have seen earnings upgrade. The weakness or the downgrade were more seen in small and mid-cap stocks rather than large-cap stocks. Overall, we believe against a GDP growth of about 6.8 to 7.7%, Nifty 50 companies will show growth of about 19%. This will be driven mainly by commodity companies and banking and financial services. Nifty EPS as of today looks like about 887 for FY23. Now, again, there is a chances that there will be downward revision in this, and this number may become 850 rupees as June 22 quarterly results come out. At 887, we are trading at about 18.7 times FY23. At 850, we will marginally go up. Due to all the uncertainty of oil, Russia, inflation trajectory, and US Fed rate, we believe this is time to have neutral weight allocation to equities. Within that, be marginally overweight large cap, be marginally underweight small and mid cap. From an equity investment point of view, many people will wonder, is there a fund which is a combo of hare and tortoise? On going up, it should go up like hare. On coming down, it should come like tortoise. There are three funds: Kotak Equity Savings Fund, Kotak Multi-Asset Allocator Fund of Fund, and Kotak Balance Advantage Fund, where we try to create combination of tortoise and hare. In equity savings scheme, equity allocation ranges between 10 to 50%. The average equity is about 29% since inception. And when market goes up, it gives participation of about 39%, despite average equity allocation of 29%. And when market falls, it falls about 14%. The upside downside ratio is about 2.83 for last almost 8 years. That means for every 1 rupee fall, it goes up 2.83 times. Similarly, in our multi-asset allocator fund, the range of equity is between 5% to 95%. Average equity is about 45%. And with that, it has gone up 65% when market goes up 100%, and it falls about 29.6% when market goes down 100%. The upside downside ratio is 2.19 over last 18 years. For 18 years, this fund has delivered about 2 times upside compared to downside. Balance Advantage Fund again is a Harfan Maula fund. The equity range is roughly about 20% to 80%. In equity, average equity allocation is about 43.1%. And on the way up, it gives participation of 56%. And on the way down, it gives participation of about 36%. The upside downside ratio is about 1.59 over a period of 3.8 years. These are all the funds which have fantastic upside downside ratio. And this can be projected as a tortoise and hare combo with the investors. There is also a lot of media articles about fund managers not generating alpha and fund managers struggling to add value to customers. If we look at a combination of fund where a large cap fund like Kotak Blue Chip and a concentrated fund or a focused fund like Kotak Focus, if one can combine them, it does create a lot of value for customers. The excess return generated by this kind of combination approach can give alpha of anywhere between 2% to 1% to investors. Even otherwise, without combination, if we look at most of the Kotak funds, they have added value to the investors ranging from 0.5% to as high as 17%. Even our hybrid funds have consistently generated alpha over 3-year, 5-year, 7-year period. When people do SIP with us, even on SIP, we have generated consistent alpha bearing 1 or 2 funds. The same thing is true in hybrid funds. This is what we recommend to investors for SIP portfolio. For conservative investor, they should do SIP in Kotak Debt Hybrid Fund, which has allocation up to 25% in equity, or Kotak Equity Savings Fund, which has up to 50% allocation to equity, or Kotak Balance Advantage Fund, which can go between 20 to 80% in equity, or Kotak Equity Hybrid Scheme. For aggressive investors, one can look at focused equity fund, emerging equity fund, small cap fund, or sectoral fund or offshore fund. That combination can give them ideal risk and return mix. We had launched multi-cap NFO last year. That NAV is at about 9.16 today. It is trading below 10 rupee. However, if we look at the since inception performance, by and large, it has been able to build a portfolio which is mimicking the index. We had also launched Kotak Global Innovation Fund of Fund last year. That fund has really seen sharp deterioration in performance. It's down about 30% from the top. Current NAV is roughly about 6.9 rupee. This has been a significant loss for the investors. We launched this fund in July 21, and thereafter series of events have happened which we were not able to forecast while launching the fund. The first disaster to hit this fund was Chinese tech crackdown. President Xi Jinping talked about common prosperity. That hit Chinese tech companies' valuation significantly, and they corrected by about 70%. Thereafter, there was a rout in Nasdaq with US Fed rates increasing and liquidity getting tighter. half of Nasdaq is down more than 50%. Combination of China sell-off and Nasdaq correction resulted into this fund dropping about 30% from top. And most importantly, today, when we believe it is great time to invest in this fund due to cap on overseas funds investment, we can't even accept the money and allow investors to average. In this kind of unfortunate scenario where markets have corrected and it is good time to invest, we are not able to take any money. All we recommend investors is patience. Obviously, losing 30% is a very, very painful thing, but one should not lose hope. This fund is managed by Wellington Asset Management Company. Our fund goes and invests into their innovation fund. They have taken necessary corrective measures on the portfolio, and hopefully in the days to come, it will start reflecting into performance. Why should one invest during the bad time? Well, if you catch falling knife, eventually you make money during good time. In 2020 beginning, markets corrected 37%, but now they are up more than 100%. The same experience was there in 2016 as well as 2008-9 subprime crisis. Coming to gold, we have been bullish gold for last couple of years. It worked well in 2020, didn't work at all in 2021, and it's mixed bag in 2022. Our reason for remaining bullish on gold is that compared to equity or compared to S&P 500 to be more precise, it looks fairly attractive. In a global uncertainty of rising inflation, generally gold does well. Gold does well even during wartime scenario. And today with Russia, Ukraine and rising inflation, gold certainly deserves a place in your portfolio. We also believe China will be a big buyer of gold in the days to come. Like Russia was before Ukraine invasion, China has a view on Taiwan, and they may do something to shift part of their $3 trillion reserve into an asset like gold, which can be confiscated, which can be frozen. So maybe we are all front running China's buying of gold in the days to come. On the crypto, clearly there has been massive correction across entire basket, and nothing explains better than this NFT correction, where someone was expecting first tweet NFT to go on sale at $48 million. That's roughly about 350 crore. And it actually went into the market at just about 280. The first bid came at just about $280. That's a 99.9% correction in price. There was a country in Latin America called El Salvador. They accepted Bitcoin as a part of FX reserve, and now they are likely to default as Bitcoin prices have corrected. There was a crypto called Terra Luna. It collapsed 98% overnight, and people lost tons of money. The biggest scandal in investment world was Bernie Madoff. People lost about $60 billion at face value and about $18 billion in real sense. In the Terra Luna crypto itself, people have lost close to $60 billion. Warren Buffett, when it conducted its Berkshire Hathaway annual general meeting, He says he wouldn't buy all the Bitcoins in the world, even for $25. The current market cap of Bitcoin will be several $100 billion. And Warren Buffett says that he wouldn't even pay $25 for it. His partner, Charlie Munger, was even more scathing in his comments. He says, as an investor, I avoid things that are evil, that are stupid, and that make me look bad. Bitcoin does all three. Coming from crypto to debt market, as I mentioned earlier, inflation has shot up across the world. It's running into decadal high level in places like Germany, US, Sri Lanka, Italy, UK, Turkey. There are very few countries where inflation is in low single digit, like China or Hong Kong. Globally, all central bankers have started raising interest rates. China is the sole exception, which has actually cut interest rates. As central bankers started raising interest rates, across the world, market yields also started moving up. 10-year US yield, which was moving with one big figure, has now entered into two big figure territory. In India, RBI has shifted focus from growth to inflation. Last couple of readings on inflation is above RBI's comfort zone of 6% and is likely to continue at least up till September 2022. Apart from raising policy rates, RBI has also started taking out liquidity. FPI selling resulting into FX outflow have helped RBI in reducing liquidity. CRR increase has also reduced liquidity in banking system to the extent of about 87,000 crore. As of today, while India is witnessing inflation above RBI's comfort level, at least from a real rate point of view, it is not as worse as some of the countries like US, UK, Singapore, Australia. In this kind of uncertain environment, we believe the short to medium end of the curve appears little bit better. Yields have increased sharply between 1 year to 3 year segment, and 3 to 7 year segment continues to look attractive. In some sense, RBI's forewarning market, it has given enough indicators that it is likely to raise policy rates, and which is where, to a great extent, market is pricing in rate hikes anywhere between 125 basis point to 150 basis point. This is probably one of that rare time where Indian real interest rates are trading at a such high premium to US real rates. While it has come down a little bit in the recent time, but overall Indian interest rates provide much higher real return than US dollar rates. In the debt market, from an opportunity point of view, it's better to invest linking with your time horizon. As I mentioned earlier, that 3 to 7 year bracket looks good from an investment point of view, be it corporate bond fund, be it floating rate bond fund, be it short-term bond fund, or banking and PSU debt fund. You can also trust fund manager to manage interest rate volatility to generate return, and our dynamic bond fund continues to deliver good return. we have been saying for some time that it is time to consider investment in hybrid funds. In the past, a lot of investors used to invest in monthly income scheme. Now they have been they have been renamed as debt hybrid fund, and all our debt hybrid fund has delivered almost mid high single digit to double digit return over last 1, 3, 5, 7 year, which is significantly outperforming, let's say, something like bank deposits. The same is true about Kotak equity saving scheme, which has also delivered high single digit return, and also Kotak equity hybrid scheme, which has delivered high single digit to double digit return. All these funds have also generated value add for customers, and people who are today looking to get out of bank fixed deposits, company fixed deposits, kind of lower yielding instruments, may find hybrid fund an attractive option. Obviously, this fund's volatility will be higher compared to fixed funds, compared to fixed deposits, but they'll also provide better return. Finally, if I have to give one line message to investors, well, keep faith in India's story. Despite COVID, despite higher oil prices, we have made distinctive progress in last 8 years. I was with Finance Minister in US where I had shared this data. In 2014, we were 10th largest economy. Today, we are 6th largest economy. And by this, in FY22, we have become 5th largest economy. Our share in global GDP was 2.6% in 14. It has become 3.2% in 21. We were having 2.1% of FDI. Now it is 6.7%. We were 7th largest automobile market. Now we are 4th largest automobile market. We were 4th largest steel producer. Now we are 2nd largest steel producer. We were 12th largest mobile manufacturer. Now we are 2nd largest mobile manufacturer. Our weight in emerging market was 6.6%, but because we did double of what emerging market as a group did, our weight is today 12%. So clearly, India growth story is in place. And despite all the uncertainty, it did well between 2014 to 2022. And I'm sure the story will continue.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.